Hello guys, happy new year. Happy 2026. We back with Moat investing. This year is gonna be a bit different. We're gonna put a lot of more effort. It's going to be a very challenging year, but we're here to make money. We closed the portfolio with 44%. Not bad for 1 year. It wasn't that difficult to be honest this year, but we still locked the S&P 500, so that's good. So let's go very fast. What we're gonna do is we're gonna just go over all the stocks that we have. So we just review all the positions that we have. And we're going to also give you a surprise. We're going to give you a last position is a value stock that for some reason is undervalued now. We're going to explain what it's a new stock that you still don't know. We're gonna just give the surprise at the end of the video. This my analyst is going to speak mostly about the stocks. I'm going to also speak about something, and also Ed is going to give a pitch on one of the stocks that we have. And we're going to start from one old stock that is actually in the art. We actually kind of love and hate this stock because probably is playing in much longer than we thought it would. It takes much longer than we thought. But the UK market is one of the most difficult. It's been very difficult market. All my UK hedge fund managers telling me that they never seen the market so cheap as it is. Probably not even, it's the cheapest it has been in the last probably 30 to 40 years. But UK economy is really bad at the moment. And some of those stocks are reflecting really the economy of UK. The FTSE is not really reflecting the economy of UK. The main index is not, because mostly in UK, in the main index, there are actually the stocks that belong to the bigger worldwide companies. So they actually reflect the economy of the global economy rather than the UK economy. The real UK economy is probably in those small cap stocks. That is the one that we look for to find the value story. Starting on Vistry, right? It's an old position for us. It's been almost 2 years. And please, Akib, you've been on this stock recently, very heavy on researching. So please tell our friends what's going on with this, what we are at, and what we should expect from it.
As Antonio said, it's an old position for us. It's been a couple of years now. I think the good thing now is the policy environment in UK has finally aligned with the way business has evolved. The new government has made a housing target of delivering 1.5 million houses in their tenure. That equates to roughly 300,000 homes per year. Now, and they have started to back this affordable program of this 1.5 million houses with a very good funding. I think this is a record for the UK government. They have established a 39 billion pounds for social and affordable housing programs. They've allocated 2 billion more towards affordable housing funds, which is going to run to 2026. It was top of program for the previous one. And then there is 950 million pounds for the local housing authority. So all in all, this is in excess of 40 billion pounds, 41, 42 billion pounds of housing programs. The market history. Now, before there was a huge discussion about the funding and everything, but now I think execution is the bottleneck for Vistry, not the funding anymore. They should have the funding starting by this year. So execution is really the bottleneck that Vistry needs to overcome. Now, Vistry has the scale, they have the land access, they have operating relationships with the housing authorities. So this puts them at the center of government's housing push. They are the biggest one. If the government wants to execute their and deliver on their promises, they need Vistry more than we need Vistry to perform these promises. So government needs Vistry if they want to deliver on their campaign promises. So I think Vistry is at the center stage of this thing. Of course, one of the risks is under delivery on the government's promises. But I think the housing crisis in UK is so deep now that they cannot go without delivering on these promises into the next elections. And Vistry, I think, is at the center stage to help them achieve these promises. And that's why I think Vistry right now is very good stock to look at. Very interesting stock to look at right now.
Yeah, I mean, there's two things that I always look in the stock that I try to understand why I should buy. And one thing is understanding if there is at least alignment of shareholder interest with the minorities. And like the fact that there was a purchase, there was insider purchase from Greg. Greg is the CEO, the old CEO. It wasn't really meaningful for him. It was £500,000, I think. And even if they did decrease the £1 billion buying back, I think they're still buying. I think they still buy constantly £200,000 a day. Another thing that I like in the builder, there's an old rule that says that you should always buy when it's very close or below, that you can buy below tangible book value, and sell when it's 2 times, that. Vistry, why tangible book value for a builder means that you're actually buying those dwellings at cost, right? Which is quite interesting. And that happen all the time. Anytime that Vistry dropped below the 600 was a blood bargain. Even now, I think it's very close to tangible book value. I think I don't remember, but I think tangible book value should be anything between 620 to 650. So it's still very close to that. And another thing that I like is that I think that usually the market is very efficient, but Vistry seems to be really a crazy stock. Honestly, it does not have. It goes up and down like a bobo. It's like there's nothing. Sometimes it follows the American market. Sometimes there's no reason why it should go down. It goes down like 3-4%. I think that it's a crazy stock. It's really many people know Vistry, but for some reason, I think it's not being looked at anymore. It's not being taken serious anymore from the investment community because that's what you say. It's if they want to see the proof is in the pudding, they want to see that all those executions will be realized. They want to see that those accounting mistakes will not be done anymore. They want to see all these. And when there will be a minimum proof of that, plus when the confirmation of grant from the governments for the affordable home funding, I think that stock will
The new contract announcements and all of that as well.
quickly. A last thing before we finish Vistry, people ask me, what do you think it should be worth? What price should I sell? If you've been accumulating now, we're now very close to a break-even price for us. We have 700, I think, as a price. And I asked this question to you before, so given you are the one that has the valuation in your hands, but I don't want to go through that to don't make the video too complicated, but we think that it should be worth, if things goes that it should be worth at least 800 to 900, and if things go as they should go, it should be worth more than 1,000. So if you're really tired of the position, maybe drop a bit of it at 800 and start to then exit around the 1,000 mark for now. There will be I think the 14th of January is the new.
I'm not sure, but I think around that region here,
Yeah,
around that
so
time here.
we're gonna check the day again, but in January is gonna be that one. We're gonna go very thoroughly towards that and give an update on what's going on and if there is anything that we should think. So let's move on to the next stock that is also fun. I think this one is one of the one that we all love it. We made money 2 times. So this is gonna be the third time. Of course, we all know what it is. We sold the stock during the core wave acquisition speculation. We sold a very attractive price. It was 17. At the time, it was people were speculating $20, but we took our money out. We bought 7, 8, 9, and $10. We sold put on it at a very good price. Since the stock has come off now from the heights, the sentiment was cooling a few days ago actually when we were thinking about the video. Now it's picking up again because it seems like the new year is actually moving. And we took another position up. We did not take a position very meaningfully because we are worried about the EI sort of EI bubble or the EI. I won't call it bubble like they do, but the EI turmoil that probably is we're gonna face between this year and who knows when. And these EI turmoil probably is gonna touch all the EI related stocks from CoreWave, which is the main one because it's actually the main client of Quartz. But not only the main, actually, I think for now is the only client of course, CoreWave. And the thing will depend on as from the capex. People are worried that this capex won't be able to be able to produce enough free cash flow to be justified. Also, from there is some other sources that like some university professor I think is called Marcus that is actually coming up now. It's been there for a while, but now people are starting to take him seriously on the LLM not able to scale or improve at the rate that people think they would, and also the power bottleneck that will probably become an issue in the future. And so we know that these things can actually hit the market, and when narrative hits market, things go in a down spiral very quickly. So if you want to have a big position in this one, you should be hedged with some put, either on CoreWave, on this one, wherever you find cheaper, or you should just build the position slowly. We sold put at $12, which at the time was interesting. You can still go on the long dates and still find put at $12, $11 with 20% yield, which are quite interesting because below 10, at around $10 total price after you remove the credit you get from the put, I think is a very interesting deal. The reason why you should have this one is because we do think or we do believe that there is a possibility, since many report we read and people in the industry, we know that this stock can actually announce a new deal. And when that can happen, it's going to rate very quickly. The price there is now is probably fairly, we bought a $14.90. Now is $16 as we speak. It's probably fairly priced. The price should be around $16, $17. And when we mean fairly priced, we mean the price of the discount cash flow based on the actual contracts and the actual megawatt, but that actually are in contract. But if there is another contract, which will probably be there this year, this thing's going to go up dramatically, probably 40-50%, depending, of course, on the size of the new contract. So be careful, but below $15, start to accumulate or sell put 12 positions. Don't take a big position because the turmoil can actually hit you, and there will be a good chance eventually to buy when the narrative will switch back again. This thing's gonna go up again because we do believe in that beside the turmoil, then things gonna go quite well for DI in the long-term future, even if probably on the short term we can have this bad narrative. Now let's move on the next one, which is Sakib. This was my little darling at the beginning because I actually was looking at this when it came down. Some of my friends came down from the Berkshire Hathaway conference. Everybody was speaking about that in April last year, and the price was around 115. We didn't buy because we did the valuation. We thought it was pretty much fairly valued at price. But then the stock came down at $80. It was very cheap then. And okay, please go explain what it is. I just want to say something before I give it to you. This is a quality compounder company that has been hit by consumer confidence. Is one of those stories that's gonna relate when consumer confidence is gonna go up. But this is a quality top class company. This is one of those compounder that can really make a meaningful. You can grow meaningful. Those ones that with the chart going up when things improve. Please go ahead, Sakib. Explain about the company.
Its core, Decker is a brand-led footwear business with a portfolio that spans across lifestyle and performance footwear. Its two main brands are UGG and Hoka. There are some other brands like Tava, which is for the outdoors, and then there are a couple of other smaller brands as well. What makes Decker stand out is not just the brand strength, it's the economics of the business. Even after being conservative and adjusting for cycle, margin, reinvestment, and all of the other invested capital assumptions that we account for, the company continues to generate exceptionally high returns on invested capital. Even with all of those adjustments, I still get a range of around 40 to 50% return on invested capital. This is a proof that the economics of this business are of very high quality. The reason why Deckers was coming down was because of the market concerns around the growth normalization after an exceptional run, particularly from Hoka. Now, fears of them were at one stage justified, but at one stage they were peaked and they were just too much. At one stage, Deckers felt too cheap for a business which has a 50% return on capital. That's when we went in, and we are roughly, I think, doing 30 to 35% up already on our valuation. Yeah. The business now is our view is that the market was missing a bigger picture. Decker has built a disciplined operating model. They have a tight inventory controls, a growing direct to consumer a segment as well. And Oka still has a long runway internationally and across many categories. And UGG also continues to evolve beyond a single season product. When you combine durable brand assets with a very high ROIC and capital discipline, you get a business that can compound value over long term, even if growth moderates from the recent highs. So that's our main thesis of this company. A very high quality company that we are probably going to keep for the long run.
Yeah.
Combine just brand strength with the return on capital and the capital discipline. That's what you have here with Deckers.
We prefer very much these two. One stock that was good for us, which was Crocs. And we do believe that on Crocs, the story is changed. It's not particularly expensive now, but we do believe that it's quite risky because we're not sure about the Moat. We're not sure about what's going to happen with a dude segment. And those margins that were so high there start to come down, not only for the dude food, also because of the brand itself, which is actually facing, I think, competition in same segments from other brands. And it's so much different from Crocs. Much better company, even in terms of balance sheets. Obviously, this is a positive cash company of $1 billion. There's not that on Deckers I'm talking about. So compared to the one of Crocs, it's much better balance sheets, much better ability to compound. There was no easy. It was very easy to decide between the two. If you had to have one or two, Deckers was obviously a much better company. We can actually review Crocs together. If it goes down more, it could be a possibility that it's cheap because we like the buyback on Deckers, but also the lack of insider buying there again was a bit of concern.
Also, Antonio, sorry to cut you off, but when you have a brand which is losing shelf space to the competitors, and you still have to reduce your marketing spend to protect the margin. That's a business in decline. That's really concerning.
Yeah, that's really concerning as well. So that's yeah. I mean, I wouldn't short Crocs at this price, obviously, but I don't know. I'm still waiting before getting. Now, this is a company gonna have long term. I wouldn't suggest you to enter in Deckers now, but if it drops another 10-15% from here, for example, that would be good to start to buy it. We did buy a good price. Deckers. Sorry, let's go back to the new one now. Let's move to the new one. I love this one. This is my darling, and we're doing also some strategy on this. I hope I'm right on this one, but I find it's extremely cheap. This business is amazing. In Europe, we do. I don't think Americans do appreciate how important as a platform is eToro in Europe for retailers. Not only not too much on the trading side. I think more for the retailers as a community. These are like a social community platform where people get information. People can have a bank account. People can actually use the cards. They actually talk to the people. They have those fund manager like with the copy trading where people actually copy them and it's amazing. Probably is one of the most famous one amongst retailers. Now, he's been an IPO and he came down from the IPO more than 50%, right? Because he started at 55, 60, something like that, 65, and then he came down. He went up to 70, 75, and then he came down all the way down. And why? I like the reason why it's cheap. When I know why it could be cheap, and that reason is not directly connected to the value, I start to be interested. That's what really catch me in the stock, to understand why the market might actually react in that way. Because usually the market is very efficient. Don't forget, the market is quite efficient. And the mistake of value invest sometimes can be they know more than the market. It's very hard to know more than the market. But these, you have a reason. You know that from the IPO that people sell to get the money back because they've been locked years into the stock. So that is a selling pressure that is interesting coming from that. There's another thing that is interesting is the way the accounting is reported. I know that market knows that, but sometimes screeners and the way the accounting is being reported is one way that hedge fund manager also, quant manager also, automatic platform start to understand the stocks and value stocks. And sometimes when there's a discrepancy, for some reason which I'm going to explain now, between the accounting reported and the story of the stock, because they reported a certain way for certain reason, then that's actually another interesting reason why we should look into the stock. In this case, and that's why we're gonna say now in the next few minutes, the new stock also has something similar to that one. But in this one in particular, for example, the ASC 606 revenue recognition makes the accounting reporting looks a bit distorted compared to how it should be. Because when you strip out and focus on the net contribution, the economics of the platform, in that case, becomes much more clear. What happened? If you look at the way it's being reported, Sakim, you've been through this, please. You can tell in better words than what does this rule of accounting actually say the accounting how it should report it, and what is the difference on why it should not be looked at that way?
Yeah. Yeah, 356 is basically how tells you how to record your revenue. Any transaction, it basically states that you need to define how to define a principal and an agent. It says that whenever a business is involved in the transaction, it needs to understand whether it acted as a principal or as an agent. Now, there are different revenue recognition criteria for both of them. If you are an agent, you only recognize a net revenue, the net amount that you earn from that transaction. That's going towards your income statement. And usually it is like that. Now, on the other side, if you are deemed as a principal, you have to record revenue on gross basis. For example, now with eToro, how eToro generates its crypto revenue is for a very nanosecond, crypto assets sit on their balance sheet. How? When you go and buy a crypto asset from eToro platform, they buy it first on their own and then sell it to you. And in the meanwhile, they earn a small spread. Now, because of that nanosecond, when it actually owns the crypto asset, it's deemed as a principal. And because of that, they have to record it on gross basis. Now, what it means, if I go and buy $20,000 of crypto assets from them, they'll record $20,000 as a revenue. But it's not what they earned on that transaction. They probably earned, for example, $200 on it. So in actuality, the net revenue, the net contribution from this transaction was only $200. But they have to record $20,000 as a revenue, and then in the operating cost, they report $90,800 of cost from cryptocurrencies. Now, when you calculate the margins, you do operating margin over revenue, or revenue is inflated now. So
But
they look very small. So you have a business which has a growth in funded accounts, AUA, trading volumes are up, yet the margins are reported at 1%. And that's what startles the market. But when you, for the net contribution,
Yeah, please go ahead. But the margins are much.
the margin jumped to 32%.
Yeah.
It's amazing.
I do think this company has a more. What I like of this company is that the way I did the valuation, rather than going to simple, very sophisticated models and the ones that we do, for example, that come from Colombia or others, I just went and look. At the time it was 3.5. Now I think they 3.74 million of funded account, which are the accounts funded by the 3.73 from the last one. We bought actually before that. We bought when it was 3.5 or 3.6. So the accounting are actually growing, and the net contribution margin is $230 per account. Net contribution margin is the net margin per account. And basically, if you do the calculation roughly, your market cap is only a couple years of funded account margin. Now, it's true that the market is anticipating because of crypto winter, which is actually now changing because from yesterday, it doesn't look like the crypto winter anymore. It's picking up again, but the crypto winter is anticipating that the trading activity on the crypto, which is the area where they make more money on the margin side versus the equity ones, are actually is going to decrease a lot. And this can bring a decrease in growth of the accounts and a decrease in contributions. So that is going to impact, of course, the growth story. But you buying a company with 3.5 billion market cap at 2.5 V, right? You buy a company with, I think, 1.1 billion or 1.2 billion cash. They have 1.3 billion cash from the last report. And they already say that 1 billion is going to be used for acquisitions. And they feel so cheap about the stock. It's very rare at this stage after the IPO that they actually approved the $150 million buyback, which is quite a lot of money on these market caps. I do think that the acquisitions, if they do acquisition in this kind of environment, the environment is actually penalized by the eventual crypto winter, it's going to be very accretive for them. I do think that they have a possibility to grow in other markets a lot. And I do think that eToro is actually a Moat. It's a company with a big brand. People trust them. Retailers are enthusiastic about it. There is a lot of clients stay. It's true that some of the accounts are not huge because retailers with a smaller account, but it's also true that those ones are the ones that then when the market pick up, start to trade very aggressively as well with leverage and things that makes fee go up. So I do believe a lot the story. And if you look at the real valuation now, I think the adjusted EBITDA was 300 million EBITDA, right? So this thing is going 7-8 times EBITDA for a company that should be worth against, for example, a company like Robinhood, of course, it's different. They have now the forecast market and all those things that is actually moving the tokenization of the asset. So there's other things, including in Robinhood that in eToro maybe they're not, but those ones are probably 50 times, right? So there's this connection between the two valuations, which is big, and I think this gap's going to be probably eventually close one day. So another one that is an old darling of us is we've been there for a few months, and actually on this one's about 25% down. So it's one of the few that we actually losing money on for now. Very cheap story. Always again, UK consumer is really bad at the moment, but the story is interesting. And Eddie, please, maybe you want to speak about this one, that since you actually like the stock and you enter a position as well.
Yeah, recently, right?
Yes.
Yeah, B&M is a class value retailer that has historically, let's say, performed well across the different economic cycles, especially in those where the economy is going down, where in weaker environments, when the consumers trade down in search for lower prices. Over the last 3 years, for example, the company has returned back to the shareholders about £1 billion, which highlights just how cash generative is the business model. At its core, the proposition is the same. The sharp decrease in the stock is not purely a demand story. It is, we could say, primarily about trust and accounting, right? The company disclosed that certain freight and logistic costs were not correctly accrued, which temporarily overstated their operating profits and the margins of their prior periods. So this forced guidance reset and raised questions around earnings, quality of the business. So as a result, the confidence was hit and the market moved quickly to price in a much more pessimistic scenario. It's very important for the company because the new CEO has an upcoming update where he will clarify the true scale of the accounting issue. From a valuation perspective, the stock is trading on a low multiple. That implies, of course, the prolonged damage to the earnings and the credibility of the market. The opportunity here is that the market might be exaggerating these issues, and if these issues are actually short term, the stock could move up in the upcoming days.
This stock was more than double just a few years back. What I think the market does not, the old CEO, I think the CEO that just left, I think did a mess, right? And one of the things that people not, what the market is actually starting to understand, if those prices can actually, if they can maintain those prices, those margins, I think those margins that they used to have been questioned. And also, what the company answer was not really, the company answered that the way the merchandise was organized or distributed on the shelves and on the layout was not actually easy for the clients to find and to shop. So there is also an internal organization that's changing, right? And the market is not really believing it too much. And the accounting mistake was big. Usually in the industry, we say that if there's one cockroach, there is actually two or three. And it happened also to us, unfortunately, on Vistry. And it did happen to us at the time on Stellantis. So sometimes when we do get through, it's because there is some accounting sort of mistake. So let's call it the real word. Like in Stellantis, I think it was fraud, to be honest. And these get reported in a way, and we don't have any meaningful way to actually check how they reported. We just can trust the books and not really look behind it. And that's another thing. But I do think that in general, it's a company that is being proven to be shareholder friendly. So this is really good. The dividend is probably okay. It's a good dividend as well while we wait. Something that I will actually stress on. I think at this price, 8%. So if I don't mistake, it was 6% when we, at the price we bought. So that is interesting. The only concern is that it's not a company with the amazing balance sheets. It's a company that is, because of the nature of the business as well, it's a company that is leveraged, and the leverage is quite, it's not crazy, but it's a quite a good leverage. So there is, if things get distressed on the financial side, on the sales side, it's this stuff to go that bad, the company can actually get in trouble. So it's not a company that you can actually, for example, we didn't decide not to buy more, even if we are 25% down, because a company that it could relate quickly, but if things doesn't go like they should go, it can also go down. And we don't think we have much protection from the book. For example, this is not Deckers, right? It's not anything like that. It's cheap, right? But you need to be careful with cheap stuff. Yeah, keep it. Let's see if the new CEO is able to actually turn around the story. If the UK confidence from consumer standpoint return, and maybe we see if things improve, and it can be actually a good trade. If you're not in yet at this price, it's quite cheap. And if things turn bad in the next couple earnings, then we'll rediscuss and review the position. But don't go crazy on this one. I'll have a 2% position on this one. We know some funds that are value funds, specifically in Europe, which actually have big position on those ones, and they believe a lot in the story. We're probably gonna give you also an update as well. But yeah, so let's move on the next one as well. That is
One of the things that I would want to clarify on this one, Antonio, is that since it's a discount retailer, right? Almost half of their debt are the capital leases that they have on their warehouses and the property that they have. The other thing is the January update is very important, and that's part of the reason why we're not adding so aggressively at these prices. There are two things that they are going to clarify in the January update. First, if accounting mistake was a one-off, as Antonio said, if there is one cockroach, there are probably more, and we don't want to be overexposed to that thing. And the second is the results of the golden quarter. Each one was disappointing for them last year, but they kept the guidance. There was a profit warning, but they still, in Q3, they said Q3 was slower than expected, but they still kept the full year guidance. Now Q4 is going to define the whole of last year. If the golden quarter was not as satisfied as expected, stock will get a huge hit. So we are waiting for those clarifications. And if we deem after the update, even if it goes up, if we deem it a bit more clear, if we have a more clear picture, might add at a higher price then. So we are waiting for more clarity at this stage about these things.
Great. Thank you. And Sagi, please go ahead with the next one. I really like this company. I don't know. I like, for some reason, because of our experience in the merger acquisition with the tour operators, I think for some reason I get to those tour operator company, even if they're not anything crazy because the margin are not amazing, I think. But I think it's a good company and I know why it's cheap. Please go ahead. And I want to say to my guys, yes, the UK, we insisting with UK. We have a lot of UK stock. We never had so many UK stock. But the UK market is very cheap. It's honestly very cheap. As a value people, we don't find such deals in America. There's no way. The multiple is so different. True, the economy are totally different as well. True, the growth story they can have in America cannot have in Europe ever. But those things are cheap. Are only very cheap. And actually, please, Akib, go ahead and stress why it's so cheap. What the story is, yeah.
We got interested in this name, and when we were looking at the airline sector as a whole was very cheap, and we became interested in that. But when we looked at the airline companies, they came out to be cheap, and they came out to be the ones that are dying for the yield and fuel costs and all of that. And then we came across this name. Now, Jet2 is not just an airline; it's a fully integrated travel and leisure platform, combining flights with package holidays, hotels, in-resort services, and they have a very strong customer-first culture. I remember when there was COVID, a lot of flights were canceled and all of that. Jet2 was the first one that reimbursed all of their clients. First one out of all of those other airlines. That distinction matters. That customer loyalty is very important for them. Now, unlike they capture value across the entire holiday journey, which drives repeat rate. They have a very high repeat rates, better margin stability, and very stronger customer loyalty. Now, the company has consistently grown through very different environments. You look at global crisis, you look financial crisis, you look at Brexit after COVID, and post-pandemic recovery during COVID. The company has had a very disciplined growth and a very strong balance sheet. So what makes the current setup attractive is the next leg of growth, particularly coming from Gatwick. Now, management describes this as a once-in-a-generation opportunity to accelerate growth. Gatwick is the second busiest airport in UK, and this is the one which captures a lot of traffic from the high-income areas, like particularly from the south of London, I think, or the London area. And there are some reports that around 50 to 60% of people flying from Gatwick are related to the leisure, tourism, and all of those things. It's not impacted too much by the business traffic. So this company, Jet2, has not operated from Gatwick before. Now the first flight is expected to be, if I'm not wrong, March of 2026. After this, they're expected to reach out to 90% of the UK population. That's a very good thing. And that's so network-based Moat that we once saw. I would say Booking, but Booking was very different. But it's a network-based Moat that they have, the outreach that they have to the customers. And then if you look at their secured aircraft pipeline, you look at their improving automation and industry-leading customer satisfaction surveys, Jet2 is positioning itself to compound earnings as its structurally advantaged leisure operator rather than just a cyclical airliner. So I would, after looking at this company, like with Deckers versus Crocs, I did not look at the cyclical pure airliners after that. This company was more than enough for me, and it was much, much better than them.
And what do you think about the valuation? Can you go just go a bit deeper in the valuation? I think people want to know about the valuation. I remember the valuation quite well, and this one I'd like you to talk about because you actually studied the company quite well. So please, can you tell us?
Did you allow me 1 second? I can.
I liked the idea, and I liked also the fact that when remember this one we actually bought one time, and we bought 1,100, and then we sold at 1,700 something, 1,600 something. Sorry, because 1,700 was your fair price on this one, right? Well, 170 was your price, and then it came down again. So we're not that far from now, right? We bought 6-7% ago. We actually 7%, 8% up on this one.
Yeah.
13 something. But yeah, please go ahead on the valuation. Tell me more about the valuation. I think the guys want to know. And what do you think? Why do you think it's cheap? Tell us why it's cheap.
Daniel, one of the reasons is that when you look at the growth trajectory of this company, when you look at the returns of this company, approach this company from two different valuation frameworks. One is the Greek one that I usually do for the value names. The other one is a discounted cash flow. On both of them, I got a very good price target based on the return on capitals that I implied there and the growth trajectory. And the growth and the customer loyalty that I see in this company is the reason that I think this is a very nice setup. If you look at the balance sheets, exceptionally strong. If you look at times when we were looking at the two, market was pricing them as a cyclical airliner, which is it's not. It's much more different. It's not dying for the yield and the fuel cost. The operating system is different.
Yeah. Sorry, let's explain this market cap enterprise value because I think
This one is a bit confusing. Yeah.
Wow, why is that much difference? Actually, there is a reason for it, which I think we should actually explain.
Yeah.
And yeah, go ahead.
When different financial platforms present the income statement and the balance sheet, these companies, they don't differentiate between the cash that is actually the company's own or the cash that it's coming from the clients. But this company has a huge cash balance, which is not fully owned by this company. Part of that is from the clients. So when you calculate the true enterprise value, you only need to account for own cash. They report that in their 10Qs and the 10K. It's called own cash. So you need to only account for that because the way and this is another reason, Antonio, why this company is cheap. And if you look at it from the cash flow perspective, it has a very good working capital structure, a bit like booking. It has always had a positive inflows from the working capital, and but it's just not that. It's not 700 million EV. You need to adjust for the cash owed to the customers.
Yeah. And those ones, they do make some interest as well, which is like an interest, which probably is going to get reduced as well. That's on the when the interest rate will actually come down. But
it's not a huge part of
meaningful. But and one of the reason that I think the sale and not the sale, it was the chairman actually sold the company, sold a big chunk of the company a few months ago, and he said he'll keep the other shares. He will not sell for a while, but he did create a lot of pressures on the company. I just want to stress out: this company is not like a quality compounder with very high EBIT margin. What's the EBIT margin of this company? If I remember well, is in the 6-7%. So it's not like a huge. It's not like a top quality, but it's interesting because the free cash flow is quite interesting the way it flows because of the, let's call it, float of the money from the clients. The business is quite stable. It's been growing. Nice brand. Probably is not like a cyclical line, but it does have the element of cyclicality that we can play on as well due to the consumer weakness now and things. I do believe in all the British. Any British will actually know Jet2. It's quite.
And also, this is a way to go long on tourism, right? On the UK tourism market.
So, what is your fair price in the
17? My market price 1750. It's around that.
We're saying that even if it does not grow that much, they is still worth more. But if it does show more growth, then the consensus, these things can go to 18 or to £2, right? Or to 2,000 pretty easily, correct? It's not.
This 17 doesn't consider very high expectations from Gatwick. As many of you would know, I'm very conservative with the valuations. Now, this Gatwick opportunity at management is saying once in a lifetime, once in a generation opportunity. As we get the growth rates from that airport, we'll keep on updating our valuation, but I don't want to be very optimistic before. So I want to know, even if it disappoints a bit, what would the stock be worth? And it's worth around 1750.
Right. So now let's move on quickly to the other story that we have. And this is again a British company. Just to change it, this is a story that all the British people probably know, all our British friends know. Who does not know the Greggs? I would never get into a place like that because I'm Italian and I love my amazing coffee. But for a British worker, for example, Greggs is a sort of iconic store. So please go ahead. Let's go. We move as fast as we can. This one, the next one, so then we can actually speak about our story. But I love the story. I know there is an amazing compounder. There is some issues, but please go ahead, Sagib. Go ahead on this one. This is something of the way you worked really hard on these ones. I remember we did a very good valuation also by applying different methodology. We're pretty sure on this one, to be honest. It's a good story. It's been weak, but it's a good story.
Greggs, unlike, I won't say unlike BME, but Greg is a rare example of mass mass market consumer business that continues to take share while staying disciplined on the returns. Now, despite a tough UK consumer backdrop, Greg's shop sales growth has consistently outperformed. It's both its managed like-for-like sales and the broader takeaway and the fast food category. Now, this isn't accidental. It reflects a value-led proposition, high frequency usage, and a product set that resonates especially well when consumers are price sensitive. Now, in an environment where households are trading down, Greg's is a natural beneficiary rather than a casualty. Now, there were reports about Greg's prices being higher even for now for the household which are trading down. But if you look at the wide consumer backdrop and you look at the full performance from Greg's and the shop sales growth, I believe that those fears are overblown a bit. And what makes the story compelling now is that the growth is being paired with very rational capital allocation. New shops are underwritten to a 25% cash ROI at least. This is typically achieved within 2 to 3 years with mature returns of north of 30%. Cannibalization risk is something which is being actively managed, and app data shows that new shops increase overall customer visit frequency rather than simply shifting sales around the different shops. Now, with very modest maintenance capex, a strong balance sheet, progressive dividends, and the option to return surplus cash, Greg's continues to compound value through a repeatable low-risk roll-up model rather than a financial engineering platform. Now, one of the concerns was how much it can grow, how much it can keep on growing in the UK market. We are very aware of those concerns. We partly share those concerns as well. But I think the fears are overblown. The price at which we entered Grads doesn't represent any growth. We were not paying for growth. We confirmed that from different models, the Greek model, the Professor Damodaran's model, our own models. We were not paying for any growth. So that doesn't matter. It was the fears were overblown on that. So that's where we stand on Greg's.
Okay, great. And it's a great company. It's a quality company, not very leveraged at all, and always been amazing growth story. Yeah, probably the growth. I remember that the fund manager were many of them were concerned about how much can actually grow and many more, how many shops. It's a bit like of how many actually Greg shops can be around and more. But there is one, but there's still space. And anyway, we're not paying for any growth. So if things get better from the consumer side, then obviously it should rate quite quickly. The ROIC is quite good as well. It's a good quality business.
Yeah.
And yes, a dividend as well, right? If I don't mistake, is a 4% dividend. So you actually
Yes.
get paid quite well since as you wait. The price now it's cheap. I think it's a nice story. Yeah, good positions. I would allocate 3% or even 4 on these ones. We bought at 1600 something, so not too far from here. If you're still in time to get into our fairly fair price, we think is about 21, 22, right? Which is the price that we think it should be going when things get improved and some eventually growth comes out. Now, before we talk about the last one, there is one position which is our biggest position. We've been parked our money and can be more than 10% portfolio. It is an ETF and we love it. We love it because it's like a macro bet to edge also our dollars positions because some of us do not live in the States and they do have a big dollar position. Dollars is actually devaluating. That's what happened last year when actually we went up quite a while, but in April, people were getting hit on the stock market and getting hit also on the currency devaluation. So these ones will help you to fight against the dollar devaluation. It's a fantastic way. It's actually emerging market bonds denominated in local currency. So when the dollar get weak, these ones do appreciate more. It pays a dividend. It's 6%. The dividend is actually based on the bond, which are the bond of this is based on the sovereign bonds, right? Foreign sovereign bonds or emerging markets. So it's quite distributed, so it's quite safe. And it's interesting that the dividend gets paid every month except the month of January, if I don't mistake. So every month you get your money except the January one, which is 0.5 roughly per month. And meantime, as more the dollars goes down against those currency, more actually the stock appreciate. We have already 2 or 3, 5% right appreciation, and we're getting those income. And it's a very stable, as you can see from it, it's very stable. It does not have much volatility unless dollar does not actually spikes. So it's quite easy also to actually sell and eventually buy. If there is like a weakness of the dollar, and you can actually take some profit out and probably sell it, the equity that you get from the money you get from it to buy another position. So it's in the same position, not to. It's more like a macro bet and a way to park money on a bond, which is hedging against dollars. We like it strategically; it looks really nice. Now,
Last year, I think it returned 18%, if I'm not wrong, from
Yeah.
capital and the dividends.
yeah, exactly. And this one isn't somebody that not everybody can have it. We still have a position on these ones. We really spoke about many times that these ones. It's a bet on the Russian and Ukrainian peace. It didn't work out for this year. We still basically there. We didn't lose money. It's roughly priced at the price we actually enter, around between 240 to 250. It went to its 5 to 300. We did not take the money because we want to wait for the peace to be done. And when the peace will be done, these things will probably appreciate 2 or 3 times. It is worth this actually should be 4-year dividend now that actually are not being paid because stopped by, and the 4-year dividend should be a big portion of the market cap itself. To make it short, this is if the peace gets done, and the sanction lifted against the Russian stocks, these things gonna go from 250 to 700 easily. But obviously things have been much more difficult than we thought. Trump is trying to help, but situations are quite complicated on the Russian side. So something that if you're not in a rush, I will just skip for a while and eventually wait for the peace to happen. One time will happen, and Russia is a big country, it's an amazing country. And I think, I hope situation will normalize. It can take longer than we think, but a nice way to actually play the Russian piece. It seemed many times that we were close to it, and when it goes, it's like a clock that is a gauge of how is the potential possibility of a piece, right? As they get closer, the stock goes up. As they get a bit, as the percentage of success in the peace negotiation decrease, as so decrease the stocks. I guess now you would actually do it different way. You would probably buy a polymarket bet on the Russian piece, I understand. But this is a 3-pair. This is luckily easily a 2.53 pairs way to play in case there is a piece. Now let's speak about what actually we have Brazil as well. We did the story of Brazil already. We took it out of it. We did a fantastic 40% up this year. We took also the 2 times dividend, which is quite generous. We started to notice that the possibility of the leftists to win again Brazil are more than we thought at the beginning. So that's why we took position, and we actually made good profit. I will keep still at 2% position. We had a much higher position before, and wait eventually for election. Follow the election rumors. If election goes well, these stocks can actually double. If not, I think still there's a way on Brazil to play the commodity cycle that is happening. So it's a way to play the commodity cycle. It's quite good. The companies are very cheap. There's a good dividend. I think I won't add now, but if it goes down again to the 25 level, I'll probably add again. But if you don't want to play the election in November of Brazil, then I would sell between 32 to 34. Probably it's a good price to sell. If you want to play that, I think you can go much higher. Govern yourself in the sense that try to manage on your portfolio what kind of risk you want to have, but it's still very interesting. The last stock, let's move on. Everybody's waiting for you. Please, Agib. I like the story. It's a story. This is not a stock you buy to sell next week. It's not a story that can go crazy in 1 week, or it could go if they announce new deal. Then we're gonna explain how. But it's a story that I like because again here the accounting is a screw up, right? The accounting that you see on the screen does not reflect the real story of the company. When these things happen, usually screener, hedge fund manager do not catch the story, and there is a more possibility that there is a mispricing. Also, execution is not been proven yet, so some are skeptical about executions. And the energy sector is solar energy sector. We're going to explain why, but it's been a bit underperforming. But I love the story. I think the story as a moat is fantastic. Please, Agib, let's go more into details. Let's spend 5-6 minutes on these ones before we say goodbye to our friends. But let's explain what is it, what does this company does, and why it's good, and why we should keep it a couple of years to do it to prepare this one.
Golar LNG is best understood as a market-leading floating LNG. It's called an FLNG, infrastructure provider. Now, it's an FLNG infrastructure provider. I will explain what that is. It's not a shipping or a commodity business. Its assets are long life, contracted infrastructure that converts stranded or underutilized gas into LNG at the point of production. This is important. Converts
The shippings, the ships, just they can see what. Well, yeah, that's an. I think I can understand this. Yeah, very good.
So it's best understood as it converts natural gas into LNG, to liquefied natural gas, at the point of production. It's important to note at the point of production. Now, previously, if you don't have FLNGs, you need an offshore site for the gas extraction, and you need an onshore site to convert gas into liquefied natural gas. Because to transport it, it's easier to convert it into liquid form and then transport it via carriers instead of building the whole pipeline between continents and countries. So this one is much less costlier than building an onshore plant. That's the first thing. And secondly, it's much quicker than building an onshore plant. Probably need 2 to 5 years to build an onshore plant to convert gas into LNG. But this one is much quicker. And that's the whole demand point of this company. It's much quicker, it's much cheaper, and it's very flexible. If you run out of the gas reserves, if you have a problem on the onshore offshore plant, the onshore plant goes to dust. You don't have anything there. But with this one, you can relocate it to another site. So it's an infrastructure provider which has a long-term contracts on their FLNG vessels. It's not a shipping or a commodity business. Now, Golar already has multiple FLNG units, either operating or under construction, with contracts that extend for decades and generally have very high visible cash flows. What underpins the thesis on this one is the depth and the quality of the contracted cash flows. Golar has around $17 billion of adjusted EBITDA backlog. There's no way you can understand that from the accounting. Accounting serves different purpose, of course. Its purpose is not to show the backlog, but when you look at the company without knowing what's going on in the background, you don't understand it really well. But this represents roughly 20 years of infrastructure-like earnings before any commodity link upside from the current point or inflation adjustments. Now, I think, Eddie, if you move on to the next slide, you have the contact details about each vessel.
And they work. Please explain the way they work with the shipping, the way it works with the boats, with the vessels. They buy the vessel when they do have the contract with those operators, and they do buy connected to its lease, right? That they do connect to with the client. And that, I think, creates a lot of security in the way they sound a bit like very careful, very late in the way they invest. And I like that. And of course, explain the valuation, the way we value the stock, and the way we actually discount those contracts, and why there's a catalyst eventually, because I think there could be a catalyst as well. Beside the fact that we were having it for a long term, I think a new deal can actually be a catalyst for price as well.
Right now, they are operating not operating three vessels. They have 3 vessels under 20-year contracts. 2 of them are with an Argentine CESA, and one of them is actually to Mauritania. The operator on that one is BP Petroleum. This is the only one that is currently operating right now. The other 2, the Hilly, the one that you see, FLNG Hilly, is under redeployment. It's the old contract was in Cameroon. I think it runs out in the first half. It ran out in the last half of 2025. Now it's in a redeployment phase. They need to spend some capex and redeploy it to Argentina. The third one is under conversion. What does under conversion mean? They have 3 ways to build an FLNG vessel. They can either buy it from the market, they can build their own from scratch, or the best way is they convert a vessel into an FLNG vessel. The third one is under conversion. Now, the expected date on the Argentine ones is H1 of 2027, the first one. And the second one will be H1 of 2028. I think it was H2 of 2028. The new contract of FLNG Jimmy started, I think, last quarter of 2025. Right now, they have these 3 contracts on these 3 vessels. The best thing, as Anthony said, they won't build or convert or buy a new vessel unless they have a long-term contract on it. That gives us some security on the capital discipline, and it gives us much confidence in the management. They are saying that they're actively looking for MK3 MK3 and MK4 contracts. As soon as they get the contract, they start building those vessels. Why we think they have a very high probability of getting new contracts is because the way this business works, it's much more cheaper than building an onshore plant. It doesn't make any sense to build an onshore plant, especially for countries like the countries which are still in the development phase, in the developing phase, Argentina and Cameroon, Mauritania, Senegal. Instead of spending billions of dollars on capex on onshore plant, they would rather lease their vessels. So that's our catalyst, getting to new contracts.
Let me join in on the contracts. The way the contract is done is nice. Maybe not too much the first contract, but the other ones are, because you do have a fixed fee that is regardless the price of gas. Because of course the price of LNG will do have an effect on the price of the stock. Why? Because of the way the contract is organized. But in the way the lease is organized, that you have a fixed fee, and then you have part of it which is actually changing, and it's changing based on the price, right, of the gas. And I think there is a minimum floor as well, that there's a cap discount thing, and the upside is part of the upside is actually free. One part of it is free on a certain price of the, I think $8, right? $8.
Yeah. If it goes above $8,
yeah.
So they get 25% of the upside.
I think can you interpret is a safer way to actually play the gas somehow, and the part of the energy sector. And I think I look at that way somehow. It's not appreciated by the market for the reason we said. It's actually a way to actually play the gas in a safer way, because you still have, because when we're going to speak about evolution now, I think you're going to explain that you actually took whatever, there's no growth in the price at all for now. And the price is actually just reflecting the discounted leases that they have actually now. Any other extra news about a new deal is going to be a surprise for the market. It's probably going to push the price up dramatically. And eventually the downside sounds quite limited as well. They do have a bond as well on these ones, which I thought was interesting, was 8.59%. It's something that it can actually be played out. If somebody wants to look for it, please go ahead. And please go ahead. Yeah, you were talking about evaluation, so we finalized this.
One thing, as you said, there is optionality of the upside from these contracts, but there is also a floor to protect that from the downside. The floor starts at $6. This is a cap. If natural gas goes below $6, they will still get a fixed amount. If it goes above $8, they get 25% of the upside. And they have partial CPI indexation as well on the last two contracts with Argentina. After year 6, they do get, after year 6, a CPI indexation as well. So I think this is a very good way to play this infrastructure theme. And on the valuation, what we did is, if you remember what we did with Core Scientific at the time, we modeled out their future cash flows, their margins, and we decided on a discount rate, and we just tried to do a very simple NPV of these numbers. When you do the NPV at the base numbers, I think at $9 of LNG, if I'm not mistaken, and at that price, and given the discount rate, it's worth around $37, $38. So you can say it's fairly valued. You cannot say it's fairly valued because they do have growth optionality as well, but it's fairly valued given the current contracts they have. Our main thesis is not that they will just have these 3 contracts. They have the growth optionality, which for some reason market is not appreciating right now. And this growth optionality is what we are betting on in the future. MK3, MK4, the future vessel contracts are in no way priced into the story right now.
Great. Let's see how this one will play out. It's a long story. I will allocate 2% right now in this stock, and then eventually see how it plays. I won't go too much because we want to have some cash for the turmoil is going to happen. And also because this story is not a story that's going to play short term. And people are always for the long term. But then when long term happens, they start to get bored by the stock. So I know that I'd rather have that. If there is any, also it's not super cheap. Also, it could be, it can go down more. If it does, then eventually there is a possibility. Guys,
there's one more thing I need to add, sorry, Antonio. And that about Golar, one thing that I actually missed is I saw some market participants doing the NPV of Golar without considering the capex that they need to spend on these vessels. Remember, the other 2 vessels, one has a redeployment capex and the other one has a conversion capex still accruing in the contract. So after you need to take into account that capex as well. And once you do that, we get a number that we get.
which is similar to
Thank
the
you.
price that we have now in the market. Probably a little bit less now because it went up a
Yeah.
bit, but $37 is our entry price. So we entered just a few days ago. And we think that if you let run the story for 2-3 years and they do execute and they do get, even if they don't even get a new, if they get the couple contract, they should go over $100, so it can be cheaper from here. But even if they don't, they should get around $75 when things start to be more clear in the accounting and the other boats are starting to operate. So let's see how it goes. And of course, there is a execution risk. There is delay that can happen in the shipping when the vessel will be ready, and things like that happen, and we can actually eventually add on those weaknesses if they do happen. Yeah. Guys, that was amazing. I hope you liked it. I know it was a bit longer than it should have been eventually, but we always try to tell more about the story. We're gonna catch up with the new stock. We have 3 stories which are really nice. We're looking at them, eventually buying them, and they're quite interesting. They're not that cheap, but there's a situation that can actually re-rate quite quickly. So we're gonna tell those in the next couple of weeks. We're gonna catch up, and happy 2026, and thank you again to follow us on Moat Investing. Please smash the like button. Don't forget about it if you like the video. Thank you.